Welcome back to DIY Finance Guy. My name is Sergei Modilevski. Now today's video is for anybody considering making the move from a variable or adjustable rate mortgage to a fixed rate mortgage. The point of this video isn't to convince you one direction or the other. It's simply to help you make an informed decision based on where the market currently is today, as opposed to where it's been over the last 4 or 5 months. Let's jump right into it. Anybody looking to switch out of an adjustable rate mortgage where your payment changes, they want that payment security of a fixed rate mortgage. Nothing wrong with that, but let's look at the hard numbers of what that's going to mean. So an adjustable rate mortgage over the last couple of years was typically based on a rate of prime minus, let's say 1.1%. Today, that's a rate of 3.6%. The current 5-year fixed average rate is roughly 5.34, which is a difference between these two products of 1.74%. On every $100,000 of mortgage balance, that's a difference of about $98 per month. So on your own mortgage, calculate how many hundred thousands are remaining, and that'll tell you how your payment would change by making that switch. If somebody has a variable rate mortgage with a static payment, they might be feeling anxious about their amortization continuously rising, and they may want to switch to a fixed payment and a fixed amortization, but that's going to have its own set of implications, and you might see that your payment jumps in a really dramatic way. The second consideration between products is around prepayment penalty. So currently, if you're in a variable or an adjustable rate mortgage, you can break your mortgage by paying a 3-month interest penalty. It's a fixed amount. If you switch to a fixed rate mortgage, the penalty becomes 3-month interest or something called interest rate differential, the greater of the two. Now, interest rate differential penalty can be a very broad spectrum. It depends when you break your mortgage and how far into the term you are, depends on the mortgage balance, and most importantly, it depends what happens with interest rates between the time that you take that mortgage to the time that you end up breaking it. Now, particularly in an environment where in the future, if interest rates tend to fall, and you try to break that mortgage, the prepayment penalties can be massive. It's not unusual to see a prepayment penalty that's 3, 5, or more % of the outstanding mortgage balance, and that could be a real payment shock. The reality is a very high proportion of Canadians will end up breaking their mortgage during a 5-year term for a whole multitude of reasons that are difficult to foresee today. For anyone holding a variable rate mortgage, you have a static payment. Over the last 4 Bank of Canada interest rate hikes, your payment hasn't changed. If you are considering making the switch, here's another option to consider. If you look at that difference between the variable rate interest payment and the current 5-year fixed payment, you'll notice it's substantial. Like I said, $98 per month on every $100,000. You could calculate what that difference is on your mortgage. My suggestion would be to consider calculating that difference, and instead of making the switch from variable to fixed, you can apply that difference in payment on your current variable rate mortgage. By doing so, you're going to drive down the amortization of that mortgage and put yourself in a better spot. You'll also be able to maintain the flexibility of breaking out of that mortgage with a simple 3-month interest penalty. The current variable rate mortgages that are available on the market have a much smaller discount than anything that you would have received over the last 2 years. The average rate was roughly prime minus 1.1%. Today, the discount on variable rate products is more typically prime minus 0.5. So with that difference in mind, that's another kind of consideration when you're deciding to hold on to your variable rate or switch to a fixed rate mortgage. Those are some of the considerations before making a switch from variable to fixed. But right now, I want to take you down a much longer path and help you understand the macroeconomic rationale for why I anticipate we may be approaching or may have already hit peak inflation, and how that may come down and affect the path for interest rates over the months and years to come. If you want to stick around for that, that would be awesome. If you don't and you've enjoyed the little bit of helpful tips that you've received, I'd really appreciate it if you hit that like button, hit subscribe, hit the notification bell, and make sure you don't miss any of these videos going forward. We're going to be tackling a lot of difficult personal finance questions and considerations, and I'd love you to be part of the community. First, we have to better understand what drives changes in interest rates, and in this case, specifically interest rates that affect variable and adjustable rate mortgages, which is the overnight lending rate imposed by the Bank of Canada. Now, to understand that, we got to understand what is the mandate from the Bank of Canada. Well, their primary goal is to create full employment while maintaining price stability. Now, the price stability is the primary goal. And in order to do that, they have decided that inflation needs to remain within the band of 1 to 3%, ideally at that 2% mark. So according to the Bank of Canada, when inflation is close to the 2% target, the economy is running near its capacity, meaning that demand for goods and services is roughly equal to what the economy supplies. When demand exceeds capacity, inflation can go up. And that's what we saw as COVID lockdowns began to set in. So what happened was supply shrunk dramatically as manufacturing was disrupted, supply chains were disrupted. Now, demand was also supposed to subside, but federal fiscal policy and the central bank's monetary policy intervened and created an extraordinary amount of stimulus. And that's when we saw inflation set in. Now, let's take a deeper look at that. Before we evaluate where inflation is currently, let's try to understand what's happened since COVID lockdowns began and what the long-term trend for inflation has been. So what we can see in this chart is that over a 10-year trend line, inflation has been well within the Bank of Canada's band of 1 to 3%. Now, in 2020 is the anomaly. In 2020, COVID lockdowns began and economies around the world shut down. We can see that the expectation was for a huge economic contraction, and as a result, we saw huge deflationary pressure. Inflation rate dropped below 0%. What we saw was that there was a huge contraction in not only economic activity, but also production capacity. Factories closed, restaurants closed, and that was visible there. What we saw was a huge response from central banks and from governments, creating extraordinary stimulus, essentially creating artificial demand. But what wasn't resolved was the production capacity. So we created too much demand, too many dollars, chasing too few goods. And it took a little bit of time, but eventually, as consumer demand picked up, we saw inflation break through that barrier, passing 4% in 2021, and then escalating up to the 8% that we see today. Let's look at the quick one-year trend line, and we could see that since roughly December 2021, things really accelerated, and central banks fell behind the demand curve. So interest rates remained too low for too long as too many dollars chased too few goods. As production capacity remained low, supply chains remained snarled, and we see inflation picked up dramatically. So let's have a look at what's currently happening with inflation. So Canada's inflation rate rose to 8.1% in June 2022. That was the highest on record since January 1983, but it actually came in below market expectations of 8.4%. If we have a look, excluding gasoline, consumer prices rose by 6.5% annually, picking up from 6.3% in May. On a monthly basis, consumer prices rose 0.7%, below expectations of 0.9%. So on a month over month and on an annualized basis, CPI actually came in below market expectations. Now, what drove consumer prices in the month of June? Well, frankly, it was largely tied into energy and other commodity costs, which drove transportation costs, homeowner replacement costs, and it also drove food costs as well. I don't want to say these were one-time events, but they were certainly exacerbated by the war in Ukraine and the lockdowns in Shanghai. We're not on the other side of either of those events entirely, but particularly in Shanghai, production is just about back to capacity. And the war in Ukraine, we recently saw that wheat exports had actually picked back up. So hopefully we see some pressure alleviated in those categories. Now, we know this is a commodity-driven bout of inflation as well as a tight labor market. So let's have a look at all commodity prices to try to understand where inflation is going to go over the next few months. So the first commodity that we want to look at is lumber. Now, over the 5-year trend, we could see that lumber is traded at roughly $530. When COVID lockdowns began, lumber was one of those commodities that went to the moon, peaking at about roughly $1,600. Since then, it's trended down and has recently crossed into a very low territory, about roughly $530. In Canada, we actually saw producer prices for the month of June trend well below expectation. They came in at minus 1.1%, driven largely by cheaper prices for softwood lumber, which is what we're looking at right now. Since that report, prices have actually trended down substantially more to get down to about $530 today. This is one commodity, particularly driving inflation in Canada. Let's have a look at some of the others. Next, we're going to have a look at crude oil, essentially driving the cost of gasoline. Now, these are US prices, but this does translate directly in Canada as well. What we could see is that prices had peaked out, originally hitting a peak back in March of this year, then approaching that peak back in early June. But since, prices have trended down substantially. Now, today we're trading at, roughly $91 and change. Now, we can see that price fluctuate fluctuate. So right now, the United States has been releasing petroleum from their strategic reserves. That has almost certainly driven down the cost in the short term. That may climb back up, but we're also seeing a dramatic slowdown in economic activity as a result of higher borrowing rates. So that might help mitigate how much prices rise over the next couple months. That'll be a really interesting factor to play out. But we know that since the most recent producer price report for Canada for the month of June, gasoline prices have trended down substantially. We'll almost certainly see that reflected in the consumer price index report for the month of July. Next, let's have a look at natural gas. So the price of natural gas has been exacerbated by the war in Ukraine, and those prices are much worse in Europe, but they have also affected the United States and Canada as well. Now, back in June, we saw prices peak out at about $9.34. Since then, they trended down dramatically, had a sharp rebound, and then have trended down again. We can expect that that reduction in prices will also be visible in producer prices coming up in the month of July, and likely in consumer prices as well. So I want to have a look at the price of wheat and corn. If we look at the one-year trend line for wheat, we can see that prices peaked out at roughly $1,300 as the war in Ukraine began. It's remained quite elevated ever since, but most recently we've seen exports begin again out of Ukraine, and prices have trended now well below the one-year trend line. So we're currently sitting at roughly $785, and we'd expect prices to continue coming down as economic activity continues to contract as recessions set in across the world. If we have a look at the price of corn, we see a similar trend to what we saw in wheat and other food product input costs as well. So we could see that it peaked roughly around April and has since trended down. So again, these are prices, these are input costs that we expect to eventually affect retail prices, which are visible in consumer price index reports. So these are prices that peaked in April, May, June. It takes time for those input costs to work their way down to producers and then eventually to retailers and eventually to show a reduction in consumer price index report readings. So all of those are sort of factors that we anticipate will show lower CPI readings in July and August. To understand where inflation is going to be going in the months to come, we also want to look at business inventories for two segments: producer inventories and retail inventories. What I'm showing you right now is the 5-year trend line for business inventories for producers. We can see that there's a pretty steady state of growth between 0 and 1%. That's months of inventory on hand. We could see a huge spike. Now, it might not look large, but you got to think that's more than 100% growth in inventories over the last few months. Now, it's been ebbing and flowing, but it's well above the 5-year trend line. Now, if we come up a little bit, we could see that trade inventories rose 1.4% from a month earlier in May, picking up from a revised 1.3% gain in the prior months and above market expectations of 1.3%. Retailers also saw a 1.1% increase versus 0.8%. So year over year, inventories continue to jump. Now, it's difficult to always predict how that trend actually impacts the biggest retailers, so let's take a look at some other supporting evidence. One of the largest retailers in North America is Walmart, and what we know based on their last financial report. So when producers build up business inventories, it's not a direct correlation that retail companies will also build up inventories. But if we look at Walmart's most recent financial reporting, it seems as though they're also building up material inventory. And when companies do that, eventually that leads to price reductions, because the worst thing for a retailer is to sit on inventory. So Walmart says that they're going to be reducing inventory glut over the next couple quarters. Let's look at the specifics. It says it's going to need another quarter or two to work through an inventory surge that prompted markdowns and contributed to last month's steep stock decline. So these are the sort of markdowns that we anticipate will be visible in consumer prices over the next couple of months. You'd imagine that Walmart, with their excellent inventory control, is probably not an anomaly. And other retailers like Target, Macy's, or in Canada, maybe Hudson's Bay, Canadian Tire, etc., are going to be reporting something similar in the months to come. What we can see here is another chunk of the increase in inventories came from the desired replenishment of goods after supply chain disruptions last year led to a lot of out-of-stock items. So what happens is a lot of these items were stuck on cargo ships. Eventually, that inventory came into the retailer, but as interest rates have risen, consumer demand has pulled back, inventories have increased, and now that creates a glut of supply. which over time means prices will come down on those items, and we should see that reported in CPI over the next couple of months. So next, what we want to look at are other expensive input costs for retailers that ultimately bleed their way into what consumers will pay for product. One of those is shipping costs. So what we know is when there were lockdowns in China and other export countries, it was very difficult to import products from around the world. And as a result, we saw shipping container prices peak back in September of 2021 at about $11,100. Since then, we've seen a precipitous decline in shipping prices. Today, that shipping price is globally at about $6,120. Depending on which port you're shipping from and which port you're shipping to, those prices fluctuate, but the global trend has been a steep decline in shipping prices. Now, it's an input cost. That, along with other factors like producer prices, take months before they eventually bleed their way into what consumers will pay and what we see in consumer price index reports. But this is another factor on top of commodity costs and other factors that will drive down CPI in the months to come. At least that's the expectation that traders are now starting to build in. So speaking of traders, what we want to look at is how bond traders are setting expectations for what we might see in the economy. Now we can see that 5-year bond yields climbed from, roughly 1.65 all the way up to 3.6 in June of 2022. Now that was based on skyrocketing inflation and an expectation that interest rates would remain much higher for longer. Since then, we've seen overnight lending rate climb dramatically. We've seen a massive increase in 5-year fixed rates from, roughly 2% to about 5.25%, 5.5%, depending on the lender. Now, since then, as a result of some of these macroeconomic indicators that I've talked about in this video, we've seen that 5-year bond yield trend down substantially. Now, I'm not going to show it to you here, but the 10 and 2-year treasury yields in the United States are also showing an inverted yield curve, which is typically a leading indication that we're going to see a recession at some point over the next 12, 18 months, 24 months. And that's what bond traders are now starting to price in. Now, there's been a small reversal over the last couple of trading days, so it's entirely possible that this reverts and begins climbing back up. But what I've shown you today is that there's a lot of macroeconomic indications that we may have seen peak inflation, and that certainly over the next couple months, we'll see that inflation come down. Another interesting question is just at what pace will that take place, and how will that affect the Bank of Canada's appetite for continuing to increase rates? The reality is when the Bank of Canada increases those rates, there's a huge lag factor. Only certain segments of people and companies are immediately affected by that change in interest rates, and the most dramatic effect takes months before the economy feels it. So central banks are reluctant to get too far ahead of that demand curve because supply is increasing as economies open up and as production capacity ramps back up after COVID lockdowns. And at the same time, we're curbing demand. And you want to make sure that you find that equilibrium and you don't create too much supply and curb demand too much, forcing the economy into a deep recession. So there's a happy medium, and the central banks are aiming to hit that happy medium. If you enjoyed this video, please hit the like and subscribe. Leave me a comment down below and let me know which mortgage option you prefer, adjustable, variable, or fixed in this current environment. I'll see you in the next one.